Hello and welcome to our session on planning your retirement. This is a session provided by Derbyshire Pension Fund that was originally a webinar on Tuesday the 16th of September 2025, but unfortunately we had some technical issues which prevented us from recording the event on the day. So this is just a re-recording of myself and my colleague Vincent putting our commentary over the slides, which we'll be making available on the website along with a summary of the questions and answers from the original event on the 16th. Okay, so just to get started, we've got a few headline facts for the local government pension scheme. So the LGPS is tax efficient. You get tax relief on your pension contributions. What that means is that your pension contributions are deducted from your salary before tax. Members of the scheme before the 1st of April 2008 also automatically accrued a tax-free lump sum, which we'll cover in a bit more depth a bit later in the presentation. And when members are claiming their benefits, they can exchange some of their annual pension for additional lump sum up to 25% of the pension pot. And the conversion rates there is £1 for every annual pension you give up, you get £12 additional lump sum. We'll go in more depth on those items a bit later in the presentation. And to begin with, we're just going to talk over some of the key benefits of the LGPS. Okay, so it's an occupational pension scheme paid in addition to your state pension. As well as yourselves paying in, your employer also pays in contributions towards the funding of the pension benefits. It's a defined benefit scheme, which means that at the end you have a defined amount of pension that will be paid. This is different to defined contribution schemes. Defined contribution is where the pension pot is based on contributions and investment returns. Defined benefit is different. It's throughout the course of your pension membership. Your pension accrues based on your pay and your service, and it's a set calculation as to how your pension benefits are accrued, which again we'll go into a bit more depth later. The pension is index linked, so every year it retains its value in line with Consumer Prices Index, CPI. So it will retain its value. If CPI is ever negative, for active members, that means that the benefits do go down ever so slightly, but for pensioner members and deferred members, the pension benefits cannot go down by law, so they will always stay the same. Again, we'll cover revaluation and CPI a little bit later in the presentation. We've already discussed tax relief on the contributions, and we've touched on the tax-free lump sum at retirement already. There is protection for your loved ones in the LGPS, so upon you dying, there are things like survivor's pension payable to a spouse, cohabiting partner, or someone you're in civil partnership with, as well as potentially a children's pension being payable subject to certain criteria that we'll go into a bit later. There's ill health protection and ill health retirement process for people that are too poorly to continue working, and the tier of ill health awarded determines the amount of benefits paid and the length that they're paid for. And there's some contribution flexibility. You can pay more to boost your pension through APCs and AVCs, or if you're struggling to make ends meet, you can opt into the 50-50 section of the scheme, in which you'll pay half the amount of contributions and accrue half the amount of pension from that. But we'll go into all of these things in more detail later in the presentation. So We're going to discuss how pension benefits are accrued in the LGPS, and to begin with, we're going to look at the scheme as it is now, a career average revalued earnings scheme, known as a CARE scheme. And this has been what the LGPS has been since the 1st of April 2014. So all active members in the scheme are currently in the CARE scheme. It's a defined benefit. The LGPS has always been a defined benefit scheme. So just as a reminder, that means that your pension benefits accrued in line with your pay and your service. They are not accrued in line with contributions and investments returns. The accrual rate is 1/49. So what that means is that every year we take your pay and we divide it by 49 and then gets added to your annual pension amount that you've accrued. The 1/49th accrual rate is the standard accrual rate for the main section of the scheme. We mentioned earlier about the 50/50 section, where you pay half the amount of contributions and get half the amount of pension in return. If you're in the 50/50 section of the scheme, it would be 1/98th accrual rate rather than 1/49th. If you think of accrual rates like how you're going to split a cake, so if you had one cake split between 49 people and one cake split between 98 people, the cake being split between the 49 are going to have bigger slices of that cake. As we mentioned earlier, your pension benefits are revalued in line with inflation, with the Consumer Prices Index, CPI, so it retains its value. Normal pension age is linked to your state pension age, so that is the date in which you could take your benefits without any reduction or any enhancement. And we've touched on the 50/50 option already. So the CARE pension calculation is really simple. Basically, we just take your pay for the year, and this is your gross pay, and it's divided by 49, the accrual rate, and that gets you your yearly CARE pension that is added onto the annual pension that you'd accrued from the year before, and it just keeps accruing year on year after like that, 1/49th every year. So if we use this example of someone who's on £30,000 every year, we divide that by 49 and that gets them £612.24. That £612 will be revalued each year in line with inflation, so it retains its value. The revaluation rates since 2015 are on the screen now. You can see that aside from 2016, it has always been positive. So that means that every year when the pension benefits have been revalued, they have gone up to retain their value. In 2016, that minus 0.1%, as we briefly touched on earlier, what that meant was that any active members in the scheme, their benefits reduced slightly by the 0.1%, but our deferred members, who are people that have stopped paying into the scheme and not claimed their benefits yet, their deferred benefits did not go down because they cannot by law, and same with any pensions already in payment, people receiving their monthly pension from us, because that pension is already in payment, that cannot go down also. So theirs stayed the same. They did not suffer that same reduction that the active members did. So with what we've just covered, we're going to take you over an example of how someone's CARE pension will accrue over the years. For this scenario, we've assumed that this person is on £30,000 in their first year, and every year after that, they get a steady pay increase of £500. So we can see on the screen to begin with, the 14-15 year is the first year of CARE. So the opening balance is 0. They've earned £30,000 that year, so we divide that by 49, get the £612.24 that we mentioned on the previous slide. So the total annual pension at the 31st of March is £612. We revalue it in line with the cost of living adjustment, CPI 1.2%. That gets that person an additional £7.35. We add that onto the 612, so the total updated annual pension is £619.59. What then happens is that becomes the new opening balance for the next year. This person's had a £500 pay increase this year in 15-16. So we take the £30,500 divided by 49, gets them £622.45. We add that onto the opening balance to get us £1,242.04. CPI was negative that year, so unfortunately this person lost £1.24. So the total updated annual pension is £1,240.80. And it keeps building like that over the years. We're going to fast forward 6 years to bring this to more recent years to make it a bit more relevant to today's date. You can see that every time that we take the pay divided by 49, we add that amount onto the opening balance to create the total amount at 31st of March. That amount gets revalued in line with Consumer Prices Index, so you get the revalued pension at the end of each line. That becomes the next opening balance. Take the pay for that year, divide it by 49 to get this amount, add it onto the opening balance to get this, revalue all of this in line with CPI to get a total updated annual pension amount. And it just keeps building like that, and you can see at the end of the 24-25 year, the total pension that this person has earned in the care scheme is £9,000, £9,038.48. So that £9,038 is payable for life. As we mentioned, it's index linked, so it will keep retaining its value as it's increased each year in line with inflation. And when this person comes to claim that annual pension from us, they will have the option to swap some of this pension for a tax-free lump sum, which we'll cover shortly. So many of you watching this will probably joined the scheme before the 1st of April 2014, so before it was a care scheme. So now we're going to cover how pension accrued in the LGPS prior to this date. We were what's known as a final salary scheme, and how that works is that your pensionable service in the scheme is prorated for any part-time working. So if you were to work 10 years but at half time, that would be recorded as 5 years worth of pensionable service. The accrual rate was different across different dates in the scheme. So up until April 2008, the accrual rate was 1/80th, and you also accrued an automatic tax-free lump sum as part of that. In our letters, you might see that referred to as the minimum lump sum. And then in April 2008 up until March 2014, the accrual rate changed to 1/60th. So it got a little bit better. Again, if we use the cake analogy, think of one cake being split between 80 people, one cake being split between 60 people. The one being split between 60 people is going to have bigger slices of that cake. Unfortunately, though, with the better accrual rate, members did no longer accrue an automatic lump sum like they did prior to April 2008. We then look at your final pay, which is your full-time equivalent pay, usually from the final 365 days of your employment. And the formula is underneath. So if we use the scenario of someone joining the scheme in the 1st of April 1998, up until the 31st of March 2008, that is exactly 10 years worth of service. We're assuming this person is full-time, so they're getting the full 10 years worth of pensionable service. We times that by the final pay, which for this is 35,000, and we're dividing by 80 as the accrual rate. That gives this person £4,375 annual pension, and they accrued 3/80th lump sum, which is basically 3 times the annual pension amount as a minimum lump sum entitlement, tax-free, and that is £13,125. The same person continued in the scheme up till 31st of March 2014 when the accrual rate was a 60th. So again, we're just going to look at those dates. 1st of April 2008 until the 31st of March 2014 is exactly 6 years worth of pensionable service. We're using the same £35,000 final pay, and the accrual rate is a 60th. So take the 6 years, times that by 35,000, divide by 60, and you get the £3,500 annual pension. If you're part-time, your final pay will be the full-time equivalent amount, and where your part-time gets factored into the equation is the pensionable service gets reduced. So we'll have another example shortly on how this calculation differs for someone that's part-time. The final pay for your pre-14 benefits, your final salary benefits, is your pensionable pay in the last 12 months up to leaving or one of the previous 2 years if it was higher. So a little bit of protection there in those final few years. It's the pay at leaving rather than the pay at 2014. So if you leave the scheme in 2026 and you have those pre-14 benefits, the pay used will be your pay in 2026, for example. If you work part-time, the final pay is the full-time rate for your job, so it's not prorated for your part-time work, but that's where the pensionable service comes in. The service is reduced for your part-time. If your pay is reduced because of sickness, your final pay is the pay you would have received if you had not been sick. So again, a bit of extra protection for you there, so your pension does not suffer for you being off sick. So now we're just going to take all 3 of those sections of the scheme, those different tranches of service, and we're going to add them together to show how they all come together to form the final pension calculation. So if you remember from the previous slide, this person had the 10 years worth of service from 2008 up until, from 1998 until 2008. That got him an annual pension of £4,375 and the automatic tax-free lump sum of £13,125. So again, that's probably referred to as the minimum lump sum in any letters that you get from us at Derbyshire. They then had the 6 years worth of service from 2008 until 2014. That got them the annual pension of £3,500. So that's where the accrual rate changed from an 80th to a 60th, and you no longer accrued an additional tax-free lump sum. And then finally, we had the care account. So that was that table that we went over from 2014 onwards. And this person got £9,038 annual pension from that. The accrual rate again changed from 60th to 49th, so it got a bit better again. And at the bottom of the screen, you can see that the annual pension is all 3 of those added together, and the minimum lump sum this person is entitled to is £13,125. So now we're going to cover the same scenario, but if this person was part-time. So we're going to assume the member in this example works half-time, so 18 hours a week for an employer where their full-time hours are 36 per week. Care benefits are built up based on actual pay. So where the final salary benefits are built up on your pensionable service and your final pay being the full-time equivalent amount, the care benefits are just your prorated pay for your hours divided by 49. The membership in the final salary scheme is scaled down for part-time working. So in this example, the member built up 1 year of membership for every 2 years calendar length. And actual pay in the final year is 17,500 because they're half time, but their final pay is still £35,000 because we're still looking at that full-time equivalent amount. So for the care benefits, this is the amount that will be divided by 49 each year, but for the final salary benefits, this is the pay that's used in that calculation. So for this person, at 10 years from 1998 until 31st March 2008, because they work half time, that 10 years is divided in half. So they get 5 years worth of pensionable service, which has got them £2,188 annual pension. So to get that, we've done the 5 years worth of service times the £35,000 final pay and divided by 80, which is the 80th accrual rate. And they got the 3/80th tax-free lump sum automatically from that. So 3 lots of the 2,188 get you £6,563. Moving on to the period of membership between 2008 and 2014, that's 6 years calendar length. Because they worked half time, they're getting 3 years worth of pensionable service. We're timesing that by the 35,000 final pay and dividing that by 60, which is the accrual rate during that period, gets them 1,750 annual pension. And then we have the care scheme. So from the 1st of April 2014 until 31st of March 2025, 11 years. Each year we're taking their pay, that's 17,500, and dividing that by 49. Each year it's getting revalued in line with inflation. So the same example, but them being half time, you can see how that has affected their pension at the bottom. So now we're going to look at when members can retire from the LGPS. As you can see on the screen, there's a few different ways that someone can access their benefits. There's normal retirement, where someone is retiring at their unreduced date. There's early or late retirement. We've got a graphic on the next slide to help demonstrate how going before your state pension age, likely reductions will apply, and if you take your benefits after state pension age, enhancements apply. There is redundancy. So if an LGPS member is age 55 or above and they are made redundant, they gain instant access to their pension benefits that they've accrued so far without any reduction, and the employer has to pay what's known as a strain cost or a shortfall cost to the fund for that. And there is flexible retirement to help people ease into retirement. Each employer has their own discretions policy on flexible retirement and the requirements for taking flexible retirement. These are either a reduction in hours or a reduction in pay grade. And the most common is that employers will want their members to take a reduction in hours. The average tends to be that they want you to halve your hours, but it's always worth checking with your employer what their discretions policy is on flexible retirement if you want to explore that avenue. So here's the graphic I mentioned earlier. You can see how you can access your benefits any time from age 55 onwards, as long as you've left the job that you've accrued those benefits with. Any time between age 55 and your state pension age, it's likely that reductions apply. And the latest you can take your benefits is age 75. And if you take your benefits any time between state pension age and age 75, enhancements will apply. So the way to think of this is the earlier you're taking it before state pension age, reductions are applied because you're accessing those benefits for longer, and enhancements apply to the benefits after state pension age because you're accessing those benefits at a later point in time. So if you're voluntarily retiring between ages 55 and 75, you can do so without your employer's consent. Like we said earlier, you need to have left the employment that you've built those benefits on to be able to access them. You could take flexible retirement from age 55 onwards, but that's with your employer's consent. Redundancy and efficiency, anytime from age 55 onwards, as we mentioned earlier, you'll gain instant access to your benefits that you've already accrued, and that will be without any reduction, and your employer has to pay a shortfall cost to the fund for that. And there is ill health retirement as well for anyone that feels too ill to continue working. We have some slides later in the presentation to go over the ill health process and the different tiers. But that can be any age. You don't have to be 55 and over. That can be any age, and the independent medical practitioner assesses each case individually. So on the screen now you can see the reduction factors as they are currently for an LGPS pension. You can see that the number of years paid earlier, as they rise, the reduction also rises. So for some people, their state pension age is age 68. So if they chose to claim their LGPS pension at age 55, 13 years early, you can see that they'll suffer a reduction of 43.9% to that annual pension. And as we get closer to our state pension age, the number of years paid early reduces, the pension reduction percentage reduces as well. And these factors do get interpolated. So if someone was to retire somewhere between 1 and 2 years early, the reduction would be somewhere between 4.9% and 9.3%. The automatic lump sum reduction works in the same way, but you'll see that the factors only go as far as 10 years early. And that's because at the point that the lump sum was automatically accrued in the scheme back in 2008, normal pension age was age 65. So the earliest you take benefits is 55. That's why 10 years is the maximum reduction that can be applied to that lump sum. And as the different tranches of the scheme have those different unreduced dates, the different tranches can be affected by different reductions because of that. In any letters that you get from us, we calculate that for you based on the date that you're specifying, so you've not got to worry about applying that reduction yourself. Some of you might know of the 85-year rule, the magic number 85 of if your age plus your service hits 85, you have some pension protections. So this applies to members who joined the scheme before the 1st of October 2006, and it only applies to the section of membership up till the 1st of April 2008. Any 85-year rule protections are built into our estimates. So it doesn't apply to any further benefits. So you might see that just that portion is unreduced at an earlier date. So now we've just got a grid of different scenarios that will hopefully demonstrate how those scenarios alter someone's pension that they're able to claim. So first one I want to highlight is this one here, retirement at normal pension age is 66, and you can see that the annual pension is £17,194 with the lump sum of £13,125. If that person decides to retire late, so at age 70, when their normal pension age was 66, remember this is linked to state pension age, you can see that the increases mean that this person has £20,000 annual pension and a slight increase to the lump sum as well. If they were to go early at age 63 instead, you can see the reductions have been applied, and the lump sum is still the same. With the early retirement to age 58, if their normal pension age was 67, you can see that further reductions have been applied. And if someone was made redundant between 55 and 65, they've just gained instant access to the benefits they'd accrued up to that date without any reductions applied. Okay, so we've covered quite a lot there on how pension benefits are accrued in the LGPS and how they're calculated. And now I'm going to hand you over to my colleague Vincent, who is going to talk to you about lump sums.
Thanks very much, Luke. So my name is Vincent. I'm going to take you through the second half of the presentation. So if we kick off by talking about taking a lump sum. So when you come to claim your pension, you can convert some of your pension into additional tax-free lump sum. And what that means is every £1 of annual pension that you convert will give you an extra £12 tax-free lump sum. However, there is a limit on the amount you can convert, which is up to 25% of the capital value of your pension pot. So by making this decision, there is no impact on any spouse pension values after you pass away, and the decision on how much to convert is made up at the point you take your pension, and will provide a form to you with the various different options available for converting lump sum. So following on from the earlier example that Luke went through, we'll use the same standard benefit figures to demonstrate the impact of converting pension into lump sum. So just to explain, it is the standard benefit figures which are shown on pension statements throughout being an active or a deferred member. You've got to take a lump sum of at least this amount and can't work it the other way around by, say, giving up automatic lump sum to increase your pension amount. As covered earlier by Luke, if you join after 31st of March 2008, you won't have an automatic lump sum. So if we say the standard benefits at retirement are a pension of 16,913 and an automatic tax-free lump sum of 13,125. If we work out the impact of the conversion on this slide, by converting the maximum amount of pension, it increases the lump sum to 77,169 by giving up £5,337 annual pension. So this has increased the amount of lump sum by 64,000. However, it has given up the guaranteed income. So it's up to you to weigh up, and is a personal decision based on your own circumstances. Things like how old you'll be when you take your pension, how many years you think you'll receive it for, and the amount of tax you'll pay might be considerations when making your decision. And you don't have to take the maximum lump sum. You can take anywhere in between the maximum and minimum level. If there's an amount of lump sum that you'd like to take or a certain regular income you'd like to have when you retire. If you are thinking of retiring and want to know the range of pension and lump sum you can take, on My Pension Online, our online service, there is a voluntary retirement benefit projector where you can specify the retirement date, and it will provide you with an estimate as if you work up until that date. And the projector will allow you to use a sliding scale to see the impact of a lump sum conversion between the minimum and maximum levels. So in terms of how you'll fund your retirement income won't just come from the LGPS, that you've all got the state pension, any other workplace pensions you might have from other employments outside of the LGPS. Some of you may even have personal pensions and various investments and savings. So it's important to keep in touch with your other pension providers so you can plan your retirement income and when you can afford to retire. This could be by looking at your annual statements, logging into online portals, and finding out what the values actually mean when you actually come to retire. So in terms of planning your retirement, so your finances may look very differently when you retire. So looking on this slide, our example member, the person's salary is 35,000 a year whilst in employment, and their retirement income is forecast to be 28,886 a year, made up of their LGPS pension and a full state pension. So this means that their annual income after retirement will actually be 6,114 less than their salary whilst working. So planning for the drop in income is essential. If you are old enough to take it, do remember to factor in your state pension when you work out your expected income. We have shown the full state pension here, but not everyone gets the full rate, and I'll touch a bit more about the state pension later. As well as your income, your outgoings in retirement will also change. For example, travel costs might drop when you stop working as you won't be commuting to work, but your household bills might increase because of being at home more. The figures are likely to look different for all of you. Your LGPS pension may be lower than the amount shown. You might have other pensions that are already being paid or that you're planning to take. You may want to look at your own figures and see what the difference is between your in-work income and your retirement income as a bit of a starting point. So if we move on to additional pension contributions, there have been different options over the years, but this is currently the available option for buying LGPS pension. They're called additional pension contributions, or APCs. You can pay in a lump sum or make regular payments from your salary before tax in exchange for an amount of annual pension. And the cost of the pension depends on your gender, your age, how much pension you buy, and the payment period that you buy it for. So you must take the additional pension that you buy at the same time as the rest of your LGPS pension, and the additional pension gets added to your main scheme benefits that you're already accruing. In the next couple of slides, I'll just cover a couple of examples of buying an APC and what that might look like. So if we look at this first slide, so this table shows the contract length, the monthly cost for that period, the total cost over the whole contract, the total cost taking into account tax relief, and the extra pension bought before any revaluation or inflation increases. So the figures in the table are based on a 50-year-old woman buying £1,000 a year of extra pension payable from their normal pension age, and this is rounded to the nearest £1. So the extra pension would be increased if she retires after age 67, and early retirement reductions would apply if she retires before then. So as you can see, it is cheaper to buy over a shorter period, but maybe not that cheap. You would be funding 100% of the cost of the extra pension, and your employer will not be contributing towards it. Tax relief will reduce the actual cost to you. In the table, we've assumed that this member is a basic rate taxpayer. And the additional pension increases with the consumer prices index, or the rate of inflation, in the same way that your post-2014 pension does as an active member. So in this example, paying by lump sum over 1 year adds 16 or 17 years of inflation to that £1,000 a year figure. But inflation increases only apply to the pension you bought so far, so they are lower if you pay over a longer period. The factors for buying extra pension are reviewed roughly every 4 years, so members paying over, say, 10 or 15 years are likely to see different monthly costs later on in the contract. So if we ignore inflation and assume this member takes a pension at age 67, in simple terms, if she paid by lump sum, after 11.5 years she'll have got her money back. However, other questions such as how many years will the pension be paid for, and how much tax will she pay on her pension payments, and the answers will be different for everybody. If we then flick to the next example, so this is using a slightly older member, in this case a man aged 61 buying the same amount of yearly pension of £1,000. There is no option to pay over 10 or 15 years because the contract must end before he reaches his normal pension age of 67. And the total cost is higher than the previous example. However, a key difference is that we've assumed that he is a higher rate taxpayer, so the cost after tax relief is actually lower than the last example. If you would like to consider paying an APC, the best way is to enter your details into the calculator that's available and try a few different scenarios. So the QR code shown on this slide will take you to the extra pension calculator on the National LGPS member website. So that's www.lgpsmember.org, where you can find out what it would cost you to buy extra pension. Okay, if we move on to the next slide for additional voluntary contributions. So another option to pay extra into your pension is via additional voluntary contributions, otherwise known as AVCs. Our AVC provider is Prudential. AVCs offer flexible contributions which can be as much or as little as you like. You can have various different investment choices taking into account your attitude to risk. You will gain tax relief for making these contributions as they are made before paying tax. The AVC part, should you decide to take one out, sits alongside your normal LGPS pension, and you must take your AVC when you take your main scheme benefits. And when you do actually come to take your pension and your AVC, you can usually take the AVC value as part of your tax-free lump sum, but you can also buy additional pension with it or do a mixture of the two. And the fund will provide you with your options when you come to retire so you can make an informed decision. So this next slide covers a bit more context on what's meant by tax relief. So this covers a basic rate taxpayer. So in this example, if you contribute £100 into an AVC or an APC, it only costs you £80, and the bonus from tax relief is an extra £20. And if you are a 40% taxpayer, then every £100 you contribute only actually costs you £60 with £40 gain from tax relief. So a link to our AVC page is shown on the slide. If that sounds like something you'd like to investigate further, then you can start an application form to Prudential, and you can do that online. So moving on to pension scams. So if you're more than a year below your normal pension age, you can transfer your LGPS pension to another pension scheme, subject to meeting all the different conditions. If you are thinking of transferring your pension to a scheme that is not a public service pension scheme, you should think very carefully about this, as you would lose the guaranteed benefits offered by the LGPS. A transfer might not be in your best interest, or even worse, you could fall victim to a pension scam. Unfortunately, pension scams are on the rise across the pension industry, and scammers are clever and will do whatever they can to disguise themselves and get their hands on your pension. So please be cautious, particularly if anyone encourages you to transfer your benefits out of the LGPS. So to prevent scams, we as the pension fund must check lots of information before you can transfer your pension out. Depending on the amount to be transferred, you may also need to pay for independent financial advice from a qualified advisor before you can transfer. So a few warning signs to look out for. So things like promises of higher returns to help or release cash from your pension even before age 55. Unusual investments, which tend to be unregulated and high risk, or complicated structures where it isn't clear where your money will end up. Scammers might set limited time offers and send couriers to your door to sign paperwork whilst they wait. and then contact out the blue from an advisor or company you've not dealt with before are all signs that you should look out for. Okay, so if we move on to the state pension, so for this presentation we thought we'd cover a few bits on the state pension. I will say now that we aren't experts on this. Any further questions or queries on the state pension should be directed to the Department for Work and Pensions. So when will you start to receive your state pension? So it depends on when you were born. Men and women have the same state pension age now, as historically this has been different. The table shows a state pension age timetable for those who have not yet reached their state pension age. Showing the table just shows the birth dates and the retirement age depending on when you were born. I will say that the Pension Commission is currently reviewing the state pension, and so the timetable to increase these ages could change in the future. So you can claim your state pension by phone, online, or by downloading a form. You will be contacted 2 months before your state pension age, and if you aren't, you should get in contact with them. If you reach your state pension on or after 6th of April 2016, you can defer taking your state pension, and for every 9 weeks you defer, it will be increased by 1%. And that works out just under 5.8% for every full year. If you want to defer, you don't need to do anything. Your state pension will automatically be deferred until you claim it. And any extra payments, though, that you do get from deferring could be taxed when you take your state pension. So, as a member of the LGPS, you were contracted out of the second state pension, also known as additional pension or SERPs. What that means is if you were a member of the LGPS before 6th of April 2016, you would have paid lower national insurance contributions. Contracted out status ended on 6th of April 2016, and you started to pay full national insurance contributions from that date. As the LGPS is a far better arrangement than the state additional pension, the LGPS pension is normally greater than the additional state pension you would have received. As a result of contracting out, it could mean that you do not get the full state pension. So you can go online and obtain a state pension forecast and find out things like when you can claim it and how much it'll be, and the link is shown on the slide there, gov.uk/check state pension. Some people can increase their state pension by paying to fill gaps in the national insurance record, and a link is also shown on the slide there for making those additional contributions. So if we flick back to retiring in the LGPS and the process for that. So step 1 is to get an estimate. You can do this by using the fund's online service, My Pension Online. There's a voluntary retirement benefit projector which allows you to select a desired retirement date, and the calculator will take into account you working up until that date and include any reductions for early retirement or any additional pension for leaving after your state pension age. As mentioned earlier, there is also the option to show the effect of converting pension into additional lump sum on My Pension Online. So step 2, if you do decide to retire, give your notice and agree your leaving date with your employer. When you've set your retirement date, your employer will let us know. If you receive the same pay each month, your employer can tell us shortly before you retire. If you do get variable pay, however, your employer will let us know after your final pay has been processed. So that being said, we do suggest you plan for any delays that may be experienced by the fund in receiving your final data from your employer, as this may have an impact on when you receive your first pension payment and your lump sum payment as well. So step 3, the fund sends you your pension claim forms. Please check these carefully and ask any questions before making a final decision. If you have an AVC, you have more options about how to use it when you retire, and that additional information will be included within your letters and forms. So number 4, think carefully about your options and how to use your AVC, whether to swap pension for additional one-off lump sum, as once you've made all these decisions, you cannot change them again. And finally, step 5, we will arrange to pay your pension, any lump sum you've decided to take, and action the AVCs as you have requested, and we'll let you know when to expect payment. They will also give you some information about how your pension will be taxed, which we'll cover next. So in terms of tax, so your pension is subject to income tax if your income exceeds your personal allowance. HMRC will let us know your tax code, so we'll deduct tax as instructed. So this next slide just shows the personal allowance rates for any normal person in receipt of money, and what level of tax will apply. So if your income exceeds your personal allowance of 12,570, then 20% tax, and if you go higher than the other brackets, higher tax will be applied. So from month 1, we'll apply month 1 base rate until the tax office confirms your correct code. So what that means is we might take a bit of extra tax off you for the first few months, but as soon as that tax code comes through, any overpayment will be refunded via payroll, usually within the same tax year, or you may have to receive this direct from the tax office. Normally it just sorts itself out after 2 or 3 months. So in terms of increases to your pension, so once your LGPS pension is being paid to you, it will increase yearly in line with the Consumer Prices Index. For example, the increase in April 2025 was 1.7%. So the Consumer Prices Index is a measure of inflation, and the increase is based on the year up to the previous 30th of September and applies from the first Monday after 5th of April each year. So the inflationary CPI figure, for example, is worked out to the end of this month, and that will be the increase to be applied from April 2026. So whenever you retire during the year, you'll get a proportion of the increase depending on your retirement date. So what that means is if you retire halfway through the year, you'll get roughly half the pensions increase in the following April instead of a full year. So a few potential scenarios here. So what happens if after you've retired? So after retirement, inform your fund if your circumstances do change. So if you get a new job, there's nothing that you actually need to do. There's no impact on the pension you receive from Derbyshire Pension Fund, as the fund does not abate. So some LGPS funds reduce your pension if you get another job, but Derbyshire does not do this. So if you move abroad, if you live outside the UK, we need to check that you're receiving the pension that you're due to. This means that from time to time, we're required to check that you're alive and well. We work with a third-party company who helps us carry out this check, and we do this to safeguard against any fraudulent activity, and we may suspend your pension if you don't get in touch with us. If you change your address, you should let us know of any change of address as soon as possible. You can do this through My Pension Online, the website online form, or you can phone us and make the change over the phone. If you want to change your bank account where the pension is paid to, so Derbyshire County Council's HR services currently operate the fund's pensioner payroll service. There is a form available on our website, or you can write directly to them to make the change. If you do need to make that change, full details will have to be provided, such as your name, address, date of birth, national insurance number, and also the bank account details where the pension is currently paid to. Okay, so if we move on to death benefits, if you were to pass away whilst a pensioner, so your pension has what's called a 10-year guarantee. So what that means is if you die less than 10 years after taking your pension, the balance of 10 years pension payments will be paid as a death grant. So no death grant is paid if you die after age 75. However, the government has consulted on removing that upper age limit so that the 10-year guarantee protects all members in the same way, not just those that retire before age 65. So Derbyshire Pension Fund decides who to pay any one-off death grant to, and a completed expression of wish form lets us know your wishes. So please complete one of these forms if you haven't done already. They can be found on the forms and guides section of our website. That's derbyshirepensionfund.org.uk. If you aren't sure whether you've made a nomination or not, it will show on your My Pension online account under the nomination section. A survivor's pension is payable for life. So a survivor can be a husband, wife, civil partner, or a cohabiting partner, subject to meeting the criteria. There's also what's called a child's pension, and they can be payable to any dependent children under age 18 or under the age of 23 and in full-time education. If you have a child that's permanently disabled, either physically or mentally, and is fully dependent on you, then the fund can pay a pension at any age for the rest of their life, subject to meeting the criteria for that. So we've covered a lot of information there, and the pension fund, there's lots of other information you can find elsewhere. The pension fund isn't able to provide financial advice. We can help you understand the options available and give you information, but we can't actually tell you what to do. There are other sources of information which may be helpful when making retirement plans. So there's things like Money Helper, Age UK, Citizens Advice, HMRC, information, unbiased, and then gov.uk website as well. So in terms of what to do next, I think the most important thing is to start planning. So find out what income you'll have when you retire by engaging with your LGPS benefits, engaging with any other pension providers that you have, including your state pension, monitor any savings and investments, and think about what you're spending money on in retirement as well. And use all the information and links that you've learned today to get as much information as possible so that you can be fully informed to make your retirement decisions. So that brings me on to our final slide of the session, just to say thank you for watching this video. I know we've covered a lot there, but hopefully at least some of the video was useful to you. If you do need to contact the fund on more specific situations to yourself, then please don't hesitate to contact us through My Pension Online or the website contact form. Thank you.
Thank you.